Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that just really don't make any sense. And what I want to talk about today is, no, the Fed is not doing quantitative easing for. I mean, all of a sudden, out of nowhere, based on a speech Fed Chair Powell gave yesterday, where he said the Fed was going to increase the size of its balance sheet. By that night, we had news outlets, banks writing articles, analysts, experts, not investors, but portfolio managers, money managers. People are just shooting articles out. Here comes quantitative easing 4. And they're wrong. And I'm going to prove it to you. And then I'm going to show you how to think like the smart money, because the smart money here is the banks. And guess who was first on this push? They're the banks. And now you're going to find out how to think like the smart money. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. All right. Let me clear that off my screen and get loaded up what I want to show you. All right. First up, shoot, that's right. They haven't fixed that yet. You get to see my full screen just because they still haven't fixed the software issue, or I haven't figured out how to change the settings, one of the two. Anyways, the Fed does organically grow their balance sheet. That is what Fed Chair Powell said. Now, there's a simple way to find the answer if that is fact or fiction. Let's go look at the Fed's balance sheet. And here you see on the Federal Reserve database, hosted by the St. Louis Fed, total assets less eliminations from consolidations of the Federal Reserve balance sheet. This is their balance sheet. And somewhere maybe down here it'll say that, but it doesn't. But this is it. I pulled this up. And what you can see, at least going back until 2002, I'm assuming there must be data prior to this. Why it's not here, I don't know. Could be they did have an older version of this, so maybe there's old data sitting there. Who knows? But nevertheless, you can see here's their balance sheet growing. Boom, quantitative easing 1. Boom, quantitative easing 2. Boom, quantitative easing 3. Quantitative tightening, and this little this has to be, for all we can tell, and we don't know for a fact, this could be those repo operations. I mean, it seems bigger than that, but it could be. Now, you can see down here, there's a balance sheet growing. Well, there's an easier way to look at that. Let's go through and look at the percentage change from a year-over-year basis. And boom, it's very, very clear. You can see their balance sheet grows somewhere around, I'd say, 3 to 4% a year, steadily. And then you see the quantitative easing stuff, 1, 2, 3, and here's quantitative tightening. So what happened? Well, the Fed over-tightened, as we know, they always do, because in the moment they tighten, they over-tighten. And guess what? Their balance sheet probably needs to organically be growing at 3 to 4% a year. Now, I don't understand the underlying plumbing of why they need to do this. I can just tell you they need to do this. They're saying it has to do with the money market rates and these dollar liquidity shortages that they're having to run these overnight interim repo operations. Yeah, it makes perfect sense. Again, the underlying technicals of how this all works is not something I understand. But I do understand that we have a major dollar liquidity shortage, and they need to bring up their balance sheet to deal with it. So there's the evidence right there. Is that quantitative? Well, here, let's go back. Was this quantitative easing here? No. But they were growing their balance sheet. But now all of a sudden they're going back to quantitative easing 4. No. And there's no evidence of it either. There's absolutely no evidence that they're doing quantitative easing 4. The Fed has already previously stated, before quantitative easing 4 even happens, guess where the federal funds rate is going to go? 0. Is it at 0? No. Is it going to be at 0 at the end of the month? Probably not. It'd be great if you own bonds. I'd like that, but it won't. It will at some point, probably later this year, but not this month. So why would the banks be disseminating this false information? Do you think they don't know what the Fed's really doing? After all, big banks are major shareholders in the Federal Reserve, which is a private corporation. Do you think they know? You bet they know. They have a really good idea, because who does the Fed work with to do all of this plumbing stuff? The big banks. They are the smart money. They're not the only smart money, but in this realm of what we're talking about today, they are the smart money. Now think about this for a second. What were the effects of quantitative easing? They caused stock prices to go up, treasury yields to go up, volatility to go down, and bond prices to go down. Okay? Now this news started yesterday and ramped up today. Now if you're the smart money, what is your goal right now? To sell stocks and buy bonds, because you know we're headed into a global recession or potentially depression. It's going to be ugly. So what? And there's some misconception here that the smart money liquidates all their stocks. They can't. They own half the market. If they liquidate all of it, there wouldn't be a market. But they want to get out as much as they can, and then they're going to hedge that position two ways. They're going to buy volatility, and they're going to buy bonds. That's what they do. I'm not suggesting you go buy volatility, so please don't. It's a very, very dangerous trade. And if you don't understand it, and you probably don't because most people don't, it was never intended for small players to do. It was always intended for large portfolio managers. So don't ever do that. Even when we look at the charts, don't do it. So if you are a retail investor and you're looking at the news, right? You got your news. Oh man, you're looking at your phone. Woo! I got tax quantitative 4. I got to make some changes. Why? Because what is it in your mind? Stocks go up, bonds go down. What have you might have done recently? You might have sold some stocks and bought some bonds because bonds are rallying. They're almost in a bull market. They're almost ready to break out into a bull market. What does the smart money want you to do? Why don't you sell them? It's exactly what they want you to do. They want you to sell those bonds so they can buy, or sell your bonds to buy stocks. Today's trading volume was 30% lower than normal, and yet stocks were way up. See, it makes perfect sense, right? If you're looking at your screen, right, at your work, doing your work, pull up, stocks are up, bonds are down, quantities are 4. You log in your 401k, click, 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 sell, sell, buy, buy, locked in. Guess what you can't do before market close? You're right, you can't change your mind. And then all of a sudden, CNBC posts on Twitter that Reuters broke a report that Beijing lowered expectations for trade talks this week. Boom. There's your smart money play. You want to see it? I'll show you some. You're going to love this. I want you to think about how you want to be the smart money. You got to think like the smart money. Here is the S&P 500, the largest ETF. Up all day. And where did it go today? Right up to its 100-day moving average. The only reason I don't use the ETF here, I use the ETFs because it shows the volume, and the minute-to-minute moves a lot better. I like to use the major index because there, bam, tag the 100-day moving average and rejected. That is a bearish signal. Let's go look at bonds. Let's look at TLT. This is the 20-plus Treasury yield ETF, Treasury bond ETF. What happened? It went down all day. You see buying here. There's a spike of volume. Buying here, spike of volume. Buying here, spike of volume. And then bam, what happened? News reports come out. Now, in after hours trading, it's come back down. Not really a big deal because the markets don't buy it. But you see what happened? They set the market up. Because they know it's coming. And it doesn't make any sense. Today's move in the bond market makes no sense, and I'll tell you why. Because today there was a 10-year Treasury auction, and you know what the results were? It was one of the best 10-year Treasury auctions in a long time. Really, really good auction. Very strong showings, very strong demand. And guess where yields came out of that auction? The midpoint was 1.53. Do you know where 10-year Treasury is closed approximately today? Almost at 1.59. Doesn't make any sense. If you get strong demand at an auction, it tells you there's strong demand for bonds. Interest rates go down. Got to think like the smart money. All right, let's go and hit some charts up. So here, whoops, that's not what I wanted. Hold on. There we go. Here's the NASDAQ McClellan Summation Index. Proxy liquidity is headed lower, broke through 100 a couple days ago. It's still heading lower despite stock prices going up, saying liquidity is tightening. Another thing I want to talk about is the crop conditions are about to get really bad. Again, no sunspots, and you have some really none showing for a long period. Last time we had that, we had the great financial crisis. The last thing you want is a solar minimum at a time where there is a problem with crops because you cannot print money through food price inflation. Now, where did they, I'm looking for something. Here, these guys. And let's see what, I don't want to see their ads, but I want to see, is they're saying their in-house high-risk computer model shows just how strong the cold front is Friday night. Be rain, thunder, and mainly a huge blast of fall air, and you can see freezing temperatures coming. They're actually predicting things are going to be much worse than they originally thought. I'm trying to find it. Yeah, here we go. Shows a 50-degree difference in temperature from today to tomorrow in the Western Plains, 30-degree drop in the Ohio Valley. This, folks, is going to freeze crops. And when you freeze crops, they stop growing. And you can see this is going all the way down into Texas. It's going to hit a major part of the growing region. And there you go, temperature change. And it's going to be ugly. And there you go. Okay, let's take a look at some charts. 10-year Treasury yields made a very technical move today. You can see they originally had come down, found support, bounced up to resistance, came back down, and I thought this was the break to go lower. I was wrong. It's anything when anytime you buy or sell a security, you can't always be right 100% of the time. You just want to be close. So I thought this was the break because we came back up, hit resistance, failed, broke through here, crashed through resistance, and the market wanted to go back and retest this as resistance now. So it crashed through support becomes now resistance. It came back up nearly exactly to where my line is at. But when you look at the 50-day moving averages, we know rallies begin with a cross to the 50-day and continue by confirming the 50-day. And the 50-day moving average goes right back into here. It's based on closing value. So where is this going to be? It's going to close down here, then close down here. Where is this green line going to go? Down. And maybe this goes sideways for a day or two, and then it confirms it and probably moves lower. We see the same thing on 30-year yields. 30-year yields is up here on the 50-day, so this is going to be moved down. The green line goes down. You can see it even clearer on TLT. This dotted orange line is the prior all-time high of 10-year of TLT. So it's just getting ready for the major breakout. Again, broke through all-time highs, came back down, reconfirmed it. That would be your bullish signal. You see bullish buying, and then you see sell-off trying to flush the weak players out. Found support down here, closed this gap, rallied up, came up to the all-time highs, didn't make it, so that would be your signal to wait. Confirmed the 50-day moving average, saw buying, broke through the all-time prior. Again, I'm just going to say all-time high being prior all-time high. There's your bullish breakout potentially. You look to buy. It's come back down. It confirmed that today. It didn't get to it exactly, but got really close. And the 50-day moving average is rising. It goes right back to here. So again, as these lower data points get removed off the 50-day moving average, this curves up, and you'll get a confirmation. Probably, we'll see tomorrow. I'm going to guess we'll go sideways because there's a 30-year Treasury auction, and then in the days of fall, the 50-day will probably touch it real nice, act as confirmation, and then there you get off to the races. Let's see how we're doing on time. Got about a minute left. What surprises me, given the weather reports coming in the Midwest, you see ag commodities, nobody's interested. They're too focused on China. Wait till the reports come out that there's not going to be a whole lot of food. That is going to send this thing up. The last time that happened, since we went and looked at the solar minimum charts, let's go back to, here is the last solar minimum. Had a low down here of, say, around 24, high up here around 43, went up a ton, and there's a lot of people that are short this sector, a lot. Who's long? The farmers. Why? Because they know. They know what's going on. All right, so let's see. And then volatility, you can see volatility kind of fit in there. It looked like it was going to go higher. I thought it was going to go higher today, came back down, hit support, and then bounced off it with that late last minute news. Again, very, very technical move in the markets today. So we'll be back Friday, barring any PG&E outages that may or may not happen. And we'll see, again, that's why I said when we came into these trades, these long bond trades, there's going to be some volatility as we get through these treasury auctions, but we have strong 3-year, strong 10-year. Tomorrow's the 30-year, and I'm going to guess it should look pretty good for us. And the economic data completely in our favor. So I'm Steve Van Metre. I'll see you Friday. Bye now.